And now introducing Mr. Keith Lanton.
Good morning. Today is Monday, November 7th. It's our first Monday discussion in the month of November. And it's a day before Election Day here in the United States, midterm elections, which we'll talk about and what effect they may or may not have on the financial markets and how they may impact how you create your personal portfolios. This morning, I'm going to talk about some more discussion from Richer, Wiser, Happier, how the world's greatest investors win in markets and life. I'm going to share some excerpts from some discussions with legendary investor Irving Kahn and legendary value investor Jean-Marie Valliard and their thoughts on investing and life. Then we'll talk about what's going on this week. Of course, just mentioned the elections being a huge event. And we also have the inflation data, which is really central to the central bank's moves and actions going forward. After last week, we had Federal Reserve decision on interest rates increasing them by 0.75%. And then we will move into Barron's. They talk about the midterms elections, and they talk about the economy and how it's affecting businesses as well as individuals and how it may not be going quite as the experts thought just a few months ago. And then here, as we approach year-end, some tax strategies. And then we'll talk about one aspect of the bond market, mortgage-backed securities, and how mortgage-backed securities are starting to look increasingly attractive. And we'll talk about why that is and what investors may do to take advantage of a sector of the market or the bond market that had been relatively unattractive relative to other fixed income alternatives up until recently. So, Richer, Wiser, Happier, try and get us into the mindset of investment, long-term thinking, portfolio construction, sticking to our guns, conviction, some of the things that the greatest investors in the world do that we in our day-to-day lives strive to do, but we get caught up in our careers, our families, our emotions, and we very frequently don't have a centralized plan. We're just hopping from thought to thought, and we need to pull back if we want to be successful and have a tenet or a principle or a roadmap of how we as individuals in conjunction with our family and our advisors are going to structure our investments so that we can be successful and not get caught up in the moment, get caught up in the emotion, and be able to adhere to a plan. So Jean-Marie Valliard, legendary value investor, ran the first Eagle funds for a long, long time, said, because the future is uncertain, obviously it sounds simple and basic, you want to minimize your risk. Following the lead of Warren Buffett, you should always keep enough cash in reserve so that we know that we'll never be forced to sell stocks or any other beleaguered asset in a downturn. We should never borrow to excess because, as Valliard warns, debt erodes our staying power. Like him, we should avoid the temptation to speculate on hot stocks with supposedly glorious growth prospects but no margin of safety. We should bypass businesses with weak balance sheets or a looming need for external funding, which is liable to disappear in times of distress. And I would add to that, not to focus on investments because they have a large likelihood of being acquired because in times of stress, that acquirer will not be willing to pull the trigger. Irving Kahn, a disciple of Benjamin Graham, said investing is about preserving more than anything. That must be your first thought, not looking for large gains. If you achieve only reasonable returns and suffer minimal losses, you will become a wealthy man and will surpass any gambler friends you may have. Of course, it's more fun to tell tales of bold bets that earn millions or billions of dollars that are drone on all about than it is to drone on about all the accidents that never happened. So, mentioning the disaster that could have happened, that didn't happen, not a very exciting tale. talking about the big hits is exciting. You'll hear people talking about them lots of times at the dinner table if you're out at a restaurant and you're overhearing the conversation. But you probably won't hear about all the failures that risk taker was taking. Or conversely, you probably won't hear at the next table about the very wealthy gentleman or lady who's sitting there who invested their money and avoided lots of blow-ups because they didn't shoot for the moon. So the future is so intrinsically uncertain that investors should focus heavily on avoiding permanent losses and building a portfolio that can endure various states of the world. Arthur Kahn went on to say, our goal is not to try to become rich quickly, it's resilient wealth creation. You want to be structured to participate in the march of mankind, but to survive the dips along the way. It's not enough just to be conservative. You need to be willing to put cash to work when others feel least comfortable doing it. In markets, as in life, so much hinges on our ability to survive the dips. Kahn's other tenets are: it is imperative to reduce or eliminate debt, just like Mr. Aveliard, avoid leverage, and beware of excessive expenses, all of which can make us dependent on the kindness of strangers. He said, don't fixate on short-term gains or beating benchmarks. Place great emphasis on becoming shock-resistant, avoiding ruin, and once again, staying in the game. Beware of getting overconfident and complacent when your investments are working out. Don't start thinking that you're more brilliant than you are. As informed realists, we should remain keenly aware of our exposure to risk and should always require a margin of safety. It's easy to get giddy when things are good and to let down our guard and make critical mistakes. On the flip side, we cannot allow our awareness of risk to make us fearful, pessimistic, or paranoid. Friedrich Nietzsche, the German philosopher, said to stare too long into the abyss, and then you become the abyss. So, with that thought on focus and avoiding pitfalls and long-term decisions, we got to keep that mindset alongside what's taking place in the world, and then adjust our long-term thesis. So what's taken place this week and last week was the Federal Reserve raised their interest rates last week on the Fed funds rate, another 75 basis points, took the terminal rate or the current Fed funds rate to 4 to 4.25%. That is a dramatic increase in the Fed funds rate this year, taking it from 25 basis points to north of 4%, a move of magnitude of 16 times, something that many of us thought was unthinkable just 8 or 9 months ago. When gazing backwards, we have seen a tremendous move from the Federal Reserve in interest rates. But nevertheless, Chairman Powell gave us two competing visions last week, where he shared with us for the first time in the Fed's policy statement that the Fed at least is acknowledging that monetary policy works with a lag, and there's been a dramatic increase in interest rates. And in the policy statement, he said that that's something the Fed's going to consider going forward, something that was immediately interpreted as perhaps the Fed will be a little bit more dovish than they previously have been. But then in the question and answer period, Chairman Powell reiterated that it is the Fed's burning desire not to take the foot off the accelerator. They don't want the markets to misinterpret the Fed's zeal to reduce interest rates and not to glean too much from that policy statement. So initial reaction in the financial markets was to move equities up on the initial Fed announcement. And then during the Q&A period, we saw equities dip and continue to dip on Thursday. After that announcement, we got a slight bounce on Friday, and that bounce is continuing this morning. Nevertheless, the Fed is in a challenging spot right now. If you think about it, the Fed's got a dual mandate. The Fed's mandate is to have maximum employment and to have low inflation. And if you look backwards, policy was relatively easy when you think about that mandate prior to the most recent rise in interest rates. We had the pandemic, and we had inflation really come down, and expectations of inflation decline as the economy was slowing. At the same time, we had employment significantly dropping. So looking backwards, the decision to cut interest rates and keep interest rates low, relatively easy decision by the Fed to engage in low interest rate policy. Then on the flip side, what we've seen is employment come screaming back. We've seen the unemployment rate dip to 3.5% in the last few months, and we've seen inflation increase significantly. So when looking at the Fed's dual mandate, pretty easy to see, well, the Fed should really focus on lowering inflation, raising interest rates, slowing the economy. The next couple of Fed meetings aren't going to be so easy. Monetary policy works with a lag. We're starting to see some weakness in the economy, certainly in interest rate sectors like housing and construction. And the Fed is going to be more challenged to come up with a cohesive plan going forward when inflation still maybe showing signs of accelerating, or at least sticking around longer than hoped for, and we start to see jobs and the economy start to weaken. The Fed's policy going forward will require a lot more delicacy and a lot more finesse than what we've seen before, which could create a lot more angst in financial markets, even than we've already seen. Especially as it applies to the Federal Reserve. So we'll talk a little bit more about that when we talk about Barron's, and now we'll focus on what's going on this morning here in the financial markets. So S&P futures this morning are up about 14 points, or 0.4% above fair value. NASDAQ futures are up about 36 points. Dow futures up about 130 points. Equity futures are moving higher after Friday's upbeat finish. There is still a growing hope that China will loosen zero COVID-related restrictions, despite the spokesman for China's Health Commission saying that no changes are being made to the country's COVID protocols. Reports out of the Washington Post that the Biden administration has privately asked the Ukraine to show it's open to negotiations with Russia. In the bond market, Treasury yields this morning are mixed. 2-year note yield is up 2 basis points to 4.69. While the 10-year yield is down 2 basis points to 4.13. The U.S. dollar index pulling back 0.3%. The only economic data that we're going to get today is the September Consumer Credit Report, and that comes out at 3 o'clock today. Equity indices in the Asia-Pacific region began the week on a higher note. Japan up a little over 1%. Hong Kong up 2.7%. The Shanghai in China was up 0.2%. South Korea up 1%. Lots of saber rattling going on. The U.S. and South Korea engaging in joint military exercise, and North Korea has been firing lots of missiles and perhaps getting frustrated that the world is not paying as much attention to them with the war in Ukraine as they would like. In Europe, we are seeing markets there mostly higher. Germany up 0.8%. The FTSE in London is down 0.2% as the new government there starts getting to work on the UK and the UK economy. In news this morning, Washington Post reporting that Republicans are expected to gain control of the House as the party holds voter advantages on inflation and crime, while Democrats hold the advantage on issues of threats to democracy. Reports from Bloomberg that President Biden will soon confront oil executives on prices. Politico is reporting that Senator Manchin of West Virginia was highly critical of President Biden's comments the other day about shutting down all coal plants in the United States. Washington Post is reporting that a tropical system could impact Florida later this week. Individual companies that are in the news: Berkshire Hathaway up about 1.5% pre-market after Warren Buffett's firm reported better than expected earnings, with revenue also topping street forecasts. Berkshire did report an overall loss, however, as a falling stock market ate into the value of its investment portfolio. Meta, META, up about 2.5% in the pre-market after the Wall Street Journal reported that Facebook parent was preparing to announce large-scale layoffs. Apple down about 2% in the pre-market after it said COVID-19 restrictions are hindering iPhone production at the Foxconn factory in China. That is the world's largest iPhone production site. Also some concerns about iPhone shipments and some questioning iPhone 14 demand as well, and that all weighing on Apple. BioNTech, Pfizer's partner in the COVID-19 vaccine, they beat on revenues. They raised their guidance and outlook. Nevertheless, the stock this morning is off about 3%. Costco downgraded at Wells Fargo to equal weight from overweight. DoorDash was upgraded to outperform from perform at Oppenheimer this morning. Moving on to what we got going on this week. Of course, we already mentioned, but worth mentioning again, tomorrow, get out and vote. Midterms will determine which party controls Congress for the next 2 years. Also tomorrow, we do get earnings from Constellation Energy, DuPont, and Walt Disney. And the National Federation of Independent Businesses releases its Small Business Optimism Index for October, looking for that to come in at about 92. The index has had readings below its 48-year average of 98 for 9 consecutive months. So small businesses, some call the canary in the coal mine, showing signs of distress. Wednesday, we get some new age companies like Rivian and Roblox announcing earnings. Thursday is a big day for inflation report. Bureau of Labor Statistics releases the Consumer Price Index for October. Economists forecast the CPI will show an increase of 8% year over year, following an 8.2% jump in September. The core CPI, which excludes volatile food and energy prices, is expected to be up 6.5%, which is a tenth of a percentage point less than last month. Friday, Veterans Day. Bond market is closed in observance of Veterans Day, and the NASDAQ and New York Stock Exchange keep regular hours. Moving on to Barron's. Barron's talked about the upcoming elections with an article entitled "Why a Split Congress Might Not Be Good for Stocks This Time Around." Traditionally, it's viewed that the split in government between the judicial, between the legislative and the executive branches is a positive because it leads to gridlock, and gridlock leads to certainty in the sense that there won't be any major new initiatives coming out of Washington, D.C., and markets value certainty. But Barron's suggesting that even though the most likely outcome is that Republicans will win the House and possibly the Senate, leaving that divided government that markets often crave for as the new paradigm, Barron's suggesting that going forward that this gridlock may not be as positive as it has been in the past, suggesting that split rule also brings the risk of political brinkmanship, which could interfere with the basic functioning of government. Congress will need to compromise on a federal budget, and will have to raise the debt ceiling sometime around the middle of next year. Also, a divided government could mean a slim chance of fiscal relief if we find ourselves in a recession next year. And as the world is becoming more and more volatile, less stable, some would argue that having a government that actually works might be a good thing in a time of turbulence. Also, if we were to have any lack of clarity with respect to control of the Senate, some are suggesting we may not know the outcome of the elections that are tight for the Senate races, and that the Senate can remain in the balance for more than a day or two. And if we were to get some people suggesting that some of those elections are unfair, or that the voting wasn't done properly, that could once again set up a challenge to the strength of our democracy, and whether or not the voting institution, which is sacred, is being adhered to properly. And that's something that could lead to pressure in financial markets. If you're looking at the volatility index, or the VIX, and seeing if that's indicating that the markets are concerned going into the election in terms of increased volatility after the election, at least at the moment, the VIX has declined. It's still elevated by recent historical standards at 25, but a couple of weeks ago it was north of 30, so perhaps markets are optimistic that there will be some clarity coming out of Washington post-election day. So last week we got that 75% basis point increase from the Federal Reserve. Barron saying the Fed is no friend to the market, how to adapt your portfolio. Last week, post-Fed announcement, the Dow was down 1.4%, outpacing the S&P, which was down over 3%, the NASDAQ, which declined over 5%. Treasury yields rose across the curve as investors priced in peak or terminal rates at the higher level of expectations. Those future rate hikes that will occur if we get that higher terminal rate will come on top of all the tightening that has already happened this year. As mentioned earlier, we started the year at 25 basis points, and here we are sitting north of 4%. We are starting to see some turbulence or some rumblings as a result of the increased interest rates this year. Commercial bank deposits are dropping. The residential and commercial real estate markets are starting to waver. The Treasury yield curve has been inverted since July, and some would suggest that these are warning signs of a possible looming recession. Perhaps most importantly, Friday's jobs report, while still stronger than some would have liked to have seen from a effect of interest rates and a bad news is good news scenario where we're looking for the labor market not to be so heated. Nevertheless, the jobs market did provide a glimpse of a cooling labor market. Payroll gains in October continuing, but unemployment rising, wage gains decelerating. So that release prompted a classic bad news is good news trading day on Friday with a little bit of bounce in the market, and we got to see some green. Barron's talked about the weakness in tech stocks and how this year has not played out for tech stocks as many would have had anticipated. So heading into this year, the theory was that business outlays on things like cloud computing and software would be resilient even if we had a weakening economy, and that the consumer would weaken and that we would see less consumers shopping. That theory seemed logical going into the year, with companies looking for ways to leverage technology to get more efficient. And looking back, that notion now looks less than perfect. Earnings reports have blown up the theory that cloud-based software companies have some magical power that makes them immune to recession. Microsoft and Amazon, the two biggest cloud companies, noted that their customers were looking for ways to tighten spending or at least get more bang for their cloud buck. Two companies that provide support services to the cloud, Twilio, Twlo, and Altacian, symbol TEAM, TEAM, two once red-hot providers of cloud-based software tools, both issued ugly forecasts for the coming months. Meanwhile, the story from the consumer economy, which was expected to be the one that showed the most weakness, is more upbeat than anyone expected. Shares of online retailing, travel, and gig economy companies all fared relatively well last week. Etsy posted third quarter revenue growth of nearly 12%, crushing guidance. eBay reported revenue above its forecast as well. And Wayfair, symbol W, said revenue was down 9%, but that wasn't as bad as feared, and all three stocks rallied. Also, if you dug into Amazon's earnings, online store sales actually grew 7%, suggesting that a lot of the weakness in Amazon's business, when you peel back the onion and dive in, was perhaps attributable to AWS or the cloud business of Amazon not living up to quarterly expectations. Also, if you're looking at the consumer, you could take a look at the travel and leisure sector, where individuals are still healthily spending money. Expedia and Booking Holdings, EXPE and BKNG, both posted revenue growth north of 20%. Booking also owns reservation service OpenTable, and trends there are good. CEO at OpenTable saying people want to get out and about. Restaurant reservations have increased. At the same time, people are still ordering food to go as well. DoorDash posted 33% revenue growth in the quarter, and that was better than not only anticipated, but better than the previous quarter growth of 25%. So here we are approaching year-end. Let's start thinking about what we can do to minimize our taxes for the rest of the year and hopefully for the rest of our lives. One thing that may make sense for a select group of investors is to consider converting their IRA to a Roth IRA. Now, lots of conditions have to be appropriate in order to do this. This is something you should consider doing in conjunction with your accountant and financial advisor, because there are lots of implications of converting an individual IRA into a Roth, and you have to take a look at your entire IRA portfolio and not just focus on perhaps the IRA that has declined most in value. But because financial markets are down and perhaps your individual IRA is down in value, it may make sense, depending on your age, your income, your future income, your estate planning, the scope and size of your retirement accounts, to consider converting to a Roth IRA from a individual retirement account, paying the taxes now and enjoying tax-free deferral for the remainder of your life. There are certainly lots of benefits there, but also lots of potential costs and pitfalls. But for the first time in a long time with markets down, it may make a little bit more sense than it has in the past. And of course, this is highly dependent on your individual situation. Also, for those who have dabbled in the crypto universe, there is a loophole that crypto investors may want to consider taking advantage of that may close in the near term. So if you are a individual investor and you want to take a tax loss, you need to sell the security that you have the loss and obviously recognize the loss. But due to wash sale rules, you cannot buy that security back for 30 days. That is not the case in the crypto world. So crypto investors can offset capital gains made elsewhere, and they can also take up to $3,000 of additional losses against gains and use those losses on their tax return. But cryptocurrencies are defined as property, meaning the wash sale rule doesn't apply. Now, tax experts suggest that if you want to sell your crypto, perhaps you wait a day or two instead of repurchasing it immediately and kind of like being directly in the face of the IRS. But many tax experts suggest that if you sell your Bitcoin, for instance, that you bought at $50,000, sell it at $20,000, and 2 or 3 days later buy it back, you should be able to do that and recognize the loss. Of course, consult with your tax advisor. Not giving tax advice here, but that appears to be what the way the law is currently constructed. And lawmakers have, in effect, acknowledged this loophole. They recently went after this loophole in the Build Back Better Act, which had language in it to make crypto not exempt from the wash sale rule, but that piece of legislation didn't pass, so you may have 1 more year to take advantage of the fact that you don't have to strictly adhere to the wash sale rule in the crypto universe. Finally, one sector of the bond market before I turn it over to Brad to talk some more about fixed income and bonds that may, for the first time, make a lot of sense, and that's mortgage-backed securities. When I got into the business in the early 1990s, mortgage-backed securities offered attractive yields relative to treasuries and were often included in investors' portfolios. As interest rates have declined, and especially as the Federal Reserve was aggressively purchasing mortgage-backed securities attractiveness relative to other taxable investments diminished significantly and didn't make as much sense to include in portfolios. But what we're seeing now is we're seeing mortgage rates for various reasons kick up to 7%, and we're at the same time have an environment where the Federal Reserve is not only not purchasing mortgage-backed securities, but they're allowing the mortgage-backed securities on the Treasury's balance sheet to roll off, creating a greater supply of mortgage-backed securities in the marketplace, which may not last indefinitely. So as a result of this, what's happened is mortgage-backed security spreads relative to treasuries have widened out to as wide as 1.75% in some cases, depending on the complexity of the security, which has created an interesting opportunity to invest in Freddie Mac, Fannie Mae, CMOs, or straight pass-through securities. If you're purchasing these securities at a discount, if interest rates decline in the future and people pay back their mortgages faster than expected, you could potentially see a windfall with investments in mortgage-backed securities. Some of the factors that are in place now, like the Federal Reserve not choosing to roll the securities on their portfolio. At some point, the Fed will stop doing that. Also, what we're seeing now is a drop in the amount of securities or securitization of mortgage-backed securities taking place as interest rates have increased. People are not taking on new mortgages or refinancing their existing mortgages. So right now we have a market where supply is greater than demand. In the future, sometime in the next, let's say, 6 to 12 months, that dynamic might shift a little bit, and some of that spread widening that we've seen may diminish. Barron's did talk about that if you're for the more aggressive portion of your portfolio, there may be opportunities in the mortgage-backed security market in some of the leveraged, publicly traded mortgage REITs like Annaly Mortgage, NLY, and AGNC Investment, symbol AGNC. These are companies that lever up mortgage-backed securities 7, 8, 9 times to 1. Not for everybody, but as a result of the dislocation in the marketplace and the drop in price of these mortgage-backed security REITs, and that doesn't mean they won't drop more, but nevertheless, the yields on these securities now are in the high teens, and in Annaly's case, almost at 20%. Of course, you're getting those returns because there is meaningful risk, but depending on your risk profile, you may say to yourself, this is a risk reward that at least Bear is looking into for a sliver, and I say sliver, of someone's portfolio if it's appropriate. I'm going to turn it over to Brad to give us some more insights into markets this morning. Good morning, Brad.
Morning, Keith. Good morning, everyone. Enjoyed your extra hour of sleep. Over the years, I've liked to make contrary decisions based on cocktail party talk, and I've mentioned that a few times. This particular weekend, I heard in at least 3 different venues, unfortunately none of them were actual cocktail parties, but how comfortable and proud people were that they had locked in 2-year Treasury rates at better than 4%. I heard a few of them actually say that they had sold their entire equity position. I'm not second-guessing anyone or any decision they make. This is certainly the safe way to go in uncertain times because ultimately you need to be able to sleep at night, and that's the most important thing. And Jerome Powell, in my opinion, has not adamantly stated that he sees an end to raising rates. As many mistakes as the Fed has made over the last year, there's no question that during the last year he has given us plenty of notice that he was going to be raising rates, and he hasn't backed down on his word. Even if Powell does continue to raise, though, if you're a long-term investor, there may be an opportunity here to lock in some of these longer-term rates. If you're conservative, 5-year municipals are trading at around 3.25%, and relatively high-grade corporates around 5.25% for 5 years. If you have a longer horizon, say 15 years, we're talking about 4.25% for tax-frees and 6% for corporates, again, in good quality. I'm seeing real demand in municipals in the 5 to 15-year range, real buying here in institutional proportions. This is the range that people want to be in, the smart money wants to be here, and a comfortable range to be in. If you're looking at 20 years, you can buy quality 4% municipals in the low 90s. That's 4.7-ish type rate of return, and that's a very nice pickup also if you want to extend those few extra years. It seems like yesterday that we were yearning for 3%. And speaking of 3%, for certain investors, maybe look at some of these 3% bonds that are getting sold out on tax loss swaps that are trading in the mid-80s, going out about 12 or 13 years. and it's a potential opportunistic trade. The great thing about it is that as long as you're in a good credit and you have patience, at maturity you're going to get par. So it's not a horrible idea to consider that for part of the portfolio. I don't like to say that I am actually bullish here because the Fed is still not our friend, but I am certainly opportunistic here. We have not seen rates like this in a long time, especially in municipals. Have a great week, and I'll pass it back to Keith. Thanks.
Thanks, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. This podcast is available on most platforms, including Apple Podcasts, Spotify, and Pandora. For more information, please visit our website at www.heroldlantern.com.
Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.